Well, stocks gained, treasuries trod water, and the dollar advanced a touch last week in what was a holiday-shortened trading week amid the Easter break, and markets overall lacked catalysts after the PCE data on Friday fell bang in line with market expectations, although there was a notable hawkish pivot in some of the Fed remarks we got last week, including those from Fed Chair Powell on Friday afternoon. Pleasingly, it is a much busier week ahead this week as the second quarter of 2024 gets underway. A jam-packed calendar of Fed speakers awaits, plus the latest PMI figures, CPI data from the Eurozone, and of course, the latest US jobs report on Friday to keep market participants busy and entertained, and also giving us plenty to discuss on this week's Trade Off UK. So let's get into the show. So proceedings a little bit quieter last week, but fingers crossed this week we see a little bit more life breathed back into the financial markets once more. Joining me, as always, to discuss everything that's going on, and very, very grateful to Ryan Littlestone from Forex Relied and Forex Analytics for interrupting his Easter getaway back to his parents' place to come and chat markets with me on a Tuesday morning. Ryan, very good morning to you. How are you doing?
Yeah, all good, Michael. Good morning to you too. Yeah, the show must go on. So here we are, keeping an eye on markets. It's the thing about trading, you're always just one sort of click away from keeping in touch with the markets, no matter whether you're on a sunbed or swanning around sunny Bishop Stortford.
Indeed, that is the nature of the world. I'm not sure sunny and Bishop Stortford have been used in the same sentence too often, but we haven't got time to get into the meteorological outlook because we need to cover the market outlook instead. So let's get on with Topical Thunder. So I'm glad you brought that up, Brian, actually, because, you know, as you said, you can stay plugged into the financial markets pretty much wherever you are at the moment, whether it's via a desktop, a laptop, or on your phone. And I think last week, and particularly developments on Wednesday evening and on Friday, really showed the importance of that for me, because we had two really interesting Fed speakers. And it just spoke to me why it's really, really important that market participants pay attention to pretty much every single word and every single sentence that is uttered by these FOMC members and other central bankers that we hear from. You know, I'd be the first to complain that we hear from central bankers too often and they say the same thing over and over again. But it is nonetheless important to listen to them, and it's important to listen so you can work out when they're not saying the same thing over and over again. And I think that's exactly what we got last week. Firstly, on Wednesday evening, we had Fed Governor Christopher Waller. He's a known hawk on the Board of Governors, and unsurprisingly, he sounded hawkish. But I think it was a little bit more hawkish than most have been expecting. I think the two key lines for me were, the first one was that he was saying that the economic data that's coming in warrants, and I quote here, fewer cuts or a later start to easing. So pretty aggressive pushback on what the market is currently pricing. And then he went further and actually said that, and I quote again, there is no rush to cut the policy rate. And of course, markets are fully pricing the first Fed cut for, I think, July at this point, and giving around a 2 in 3 chance that that cut comes in June. So Waller trying to push back on that pricing a little bit. And then on Friday, now, of course, it was Good Friday, so this seemed to fly under the radar a little bit. But we heard on Friday afternoon from Fed Chair Powell. He gave an appearance in a fireside chat at the San Francisco Fed. Pet peeve of mine, fireside chat. Why is there never a fire? But anyway, Powell gave some interesting remarks, and he really echoed what Chris Waller was saying, in that the economy is strong, and that means that the Fed don't need to be in a hurry to cut rates. And I think it was also interesting what Powell didn't say, and that is that he didn't repeat the line that he's been using for, 6-8 weeks now, in that he thinks it will be appropriate to cut rates this year. Now, fair enough that he wasn't really asked about that, but when has that ever stopped a central banker from saying what they want to say rather than just simply answering the question that they've been asked? So I think this is really interesting, because when you hear two Fed members, particularly two what I would call sort of big hitters on the FOMC, saying pretty much the same thing within 2 days of each other, That, to me, doesn't really feel like an accident. It doesn't really feel like a coincidence. And it could easily be the start of a more concerted push from FOMC members to really delay and push back on market expectations for when that first rate cut will be delivered. And handily, we have a busy calendar of Fed speak this week. We've got 18 separate remarks due from FOMC members over the next 4 days, including Powell speaking again and New York Fed President John Williams, who is another big beast on the FOMC. And I think it's going to be interesting, Ryan, to see how many more of those stress this "we're not in a rush to cut" line, and whether at the end of the week we're actually sat here going, the previous mantra from the Fed was we want confidence that inflation is getting back to 2% before we cut. Is the new mantra going to be, actually, we're in no rush to deliver that first rate cut?
Yeah, very much so. And I looked at Waller's comments, and they did seem pretty hawkish at the time. I looked back over some of his most recent remarks, and he changed from 3 cuts to 2 cuts in February. So that was when he had a little bit of a hawkish switch on his dots, shall we say, which has obviously been reflected since in the FOMC. But yeah, he has been very hawkish. We know that. There's always a balance between these guys and girls. We'd obviously hear from the doves who may be a bit dovish. And I think that's probably key at the moment. Are the doves going to start sort of taking the same sort of rhetoric on this we can wait and see, we're not in a rush? Because that, I think, will be more of a switch than hearing the same things from Powell and Waller on the hawkish side. We know, we've been saying it for months, inflation has been going the right way in part. Headline CPI has been sticky for the last 9-10 months, something that Powell reflected on at the last FOMC. So I think they are very, very scared still that inflation might be hitting a limit at the moment. It's not going to keep coming down to target. And if that's the case, like we saw with PC coming in pretty much in line, then they are going to be worried that they might have to keep rates higher for longer. And if inflation turns up, they're going to be panicked into having to possibly hike again, which they really don't want to do. So as much as they got, let's say they got their arse handed to them when inflation was rising and they were telling us it was transitory, they don't want to get their arse handed to them on the other side. If inflation starts going up again and they haven't started to cut rates, obviously being an election year as well, that's going to be very important. So, yeah, there's still a lot of fear that the job's not done. And while that's the case, they will not have this confidence, and it may mean they have to talk a bit more hawkish just to let the market do some of the extra tightening for them in those financial conditions, so they don't have to hike again. But I think going forward, I think maybe it's the doves that we're going to have to listen to this week more than the hawks.
Yeah, that's a very, very good point. And I think actually even the ISM data, the manufacturing survey that we got yesterday, within 24 trading hours of hearing from Powell, really just reiterated why that patience is necessary. The headline gauge back in expansionary territory for the first time since September 22, and the prices paid metric at its highest level since July of 2022. So again, just showing that fight against inflation in the US at least certainly isn't over. But I know you want to talk about Eurozone inflation because, things are getting a little bit interesting in the Eurozone for once.
Yeah, well, for once, he says. It's always interesting in the Eurozone, Michael.
Is it?
Yeah, and we're price watching again this week. Several pieces of inflation data drop. Europe is at the forefront as we get the flash Eurozone numbers Wednesday. We're expecting the headline to dip to 2.5%, with the core also losing a pip to 3%. Now, last week, French inflation softened to 2.4% from 3.2%, so a sizable drop there in inflation. But then Spain's rose from 2.9% to 3.2%. So there's mixed signals across the block. Now, as we're recording this, the German regional numbers are popping up. I haven't seen what they are at the moment. And the main number is due out later today. And that's expected down 2 pips at 2.5 versus 2.7 previously. So with the ECB meeting on the 11th, the results of these numbers could see the market jiggling with some rate expectations going into that. We know June is pretty much the twist date, if you like, for a cut decision. But there's still some doves, really, who have their BDI on April. So it might be more than let's say an action meeting. It might be a strong forward guidance meeting at the least. Now, I would mainly concentrate on the core number from the Eurozone data. And if that's lower than expected, say 2.5, 2.7%, then I think June's going to be nailed on for that cut. But we might get some Uber market doves who will probably be increasing their market pricing for April, and that could affect the euro, which we're already seeing a bit softer today.
Yes, indeed. I think it's an interesting one because, as you rightly said, we've had those prints come in a little bit softer than expected last week from France and from Italy. I would almost argue that in an ideal world, the ECB would actually want to cut next Thursday. The problem is they've basically boxed themselves into a corner at this point by pre-committing effectively to saying we're going to cut in June. I mean, the number of times that Lagarde, Lane, everyone else on the exec board and the governing council have said we'll know a little bit more by April, and we'll know a lot more by June, they now can't really go back on that and say, actually, we only know a little bit more, but we're going to cut anyway. So I think what we're probably going to get, as you say, is a very, very dovish hold from the ECB next Thursday, and then they will deliver that first cut in June. And I think very quickly the debate is going to turn to, and you've already started to see this from some of the speakers we've had, I think the debate is going to shift to how much do they cut rather than when does the first cut come. I think we heard from Storneras last week saying that they could cut 4 times this year. There were a couple of other speakers saying they should cut at least 50 basis points by the summer break, which is obviously at the end of July. So I think you're really going to start to see the doves begin to push quite hard for a greater magnitude of easing at this point. And I think this is where we start to talk about policy divergence once again. We just discussed the Fed beginning to turn a little bit more hawkish, talking about higher for longer again. And we're talking about the ECB turning increasingly dovish and actually maybe cutting 4 or even 5 times this year. And naturally, you would expect, all else being equal, some downward pressure on euro dollar towards my 105 target as a result.
Oh, here we go. It must have moved you away. I didn't hear a peep out of you when it was trading up at 109 again, but go on, you talk your book, mate. Yeah,
talk about what else is.
And, the ECB, another one, like the Fed, they don't want to paint themselves into a corner regarding saying that the job's done. But we also have to remember that the Eurozone rates or the ECB rates aren't as high as everywhere else. So they've got a little bit of room to perhaps wait and see. They're 75, 100 pips, depending on which rate you look at, below the Fed and the Bank of England and some of the others. So they have got a little bit more room, but then they are looking after a larger block. They're looking after, all the I can't remember how many it is now, 28 countries, is it, or 27 countries?
Yeah, something like that, yeah.
Yeah, and including obviously the 18, 19 in the Eurozone. So it's not a one size fits all. We know Germany's potentially heading for some sort of deflationary spiral at the moment, the way things are going there. So they're going to be, very cognizant of that, in particular in their deliberations. But yeah, the ECB has always been a dovish central bank. They've always been faster to cut than they have been to hike. So this is probably paining them that they might have to stay higher for longer. All we've seen in the PMIs recently out the Eurozone as well has been that price pressures remain and are still increasing, maybe not as fast as they were, but we're not seeing price cuts. We're seeing price increases still within those PMI numbers. That's across services and the manufacturing. So they are also a bit scared that they might end up like the Fed, where they see inflation coming down to maybe 2.9, 2.8, 3% mark and not going further. So if that's the case, they don't want to be cutting now to find that inflation bottoms around the sort of 3% mark and then maybe starts creeping up again. So I think anyone who's looking for 4 or 5 cuts from the ECB this year, probably a bit misplaced with those guesses. But it also depends on what the data does. As we said, if Germany and some of the others keep losing steam and inflation, then they might be forced to cut faster.
So you reckon they'll cut less than 4 times this year?
Yeah, I think so. Yeah.
Right.
Might get to 3 cuts, but again, if inflation's sub 2%, let's say by August time, yeah, they're going to increase their cuts. But if we're above 2.5% as a rough gauge towards the latter part of the year, then no, they're going to hold off cuts for the rest of it.
So did you notice that, ladies and gentlemen? He's already starting to hedge his bets on that poll. Cool. Right, we could harp on about Eurozone inflation all day, but we shall not, because there are other important matters to address this week, including the monthly jobs guessing game that we have coming up on Friday. And before anyone asks, no, I will not give you my payrolls guess now. You'll have to wait with bated breath until midday on Friday to get that. In any case, it is the first Friday of the month this week, which of course means it's time for our latest look at the US labour market. Headline non-farm payrolls set to have risen by around 200,000 in the month of March. That's a modest slowdown from the 275,000 that we saw in February, although it would take the 3-month average just a touch lower to about 240 from a prior 265, and the prior actually is the highest level since June of 2023. So I don't think we're talking about anything disastrous in terms of headline payrolls growth, although I would just caution that I think the revisions to the data need a little bit more attention than they perhaps usually get. The last time around in the February jobs report, the 2-month net revision was a frankly ridiculous minus 167,000. Now, I know there's various seasonal factors that impact the data in December and January, but nonetheless, I think that does deserve a little bit of attention. And I know last time around when we got that 275 print, but a minus 167 on the net revision, it did take some of the shine off that beat at the headline level. Meanwhile, unemployment expected to tick marginally lower to 3.8 from 3.9% previously, although as Ryan rightly said before on the show, an unemployment rate at 3.9%, or even if you put a 4 handle on the front of it, is not exactly too shabby, and still it implies an economy that is at or close to full employment, with incidentally participation expected to remain unchanged at 62.5%. And lastly, average hourly earnings seen ticking up by 0.3% on a monthly basis, a marginal quickening from the 0.1% pace that we saw in February, and that should come on an unchanged work week hours at 34.3. So all in all, we're expecting another relatively solid labour market report, and I think context is really key here, because the FOMC are expecting the labour market to soften as we move through the year. The median SEP projection has unemployment ending the year at around 4.1%. And I think as a result of that, even if we see a marginally soft jobs number, slightly below expectations, NFP, unemployment unchanged at 3.9, I don't think that's anything to be too concerned about, particularly when the Fed have said, and Powell repeated this on Friday, that it's only unexpected labour market weakness that would likely elicit a policy response, rather than a relatively slow and controlled loosening of labour market conditions. So actually, when you start to think about Fed policy, and of course the dual mandate, the risks to that dual mandate are coming back into balance a little bit more, but I still think it's the inflation side, as we discussed earlier, that is really going to drive the timing of that first cut and the magnitude of easing and normalization that's delivered this year. And as a result, barring perhaps some knee-jerk volatility around the payrolls print on Friday afternoon, I think it really is the next CPI report, which comes out on the 10th of April, so next week, that is going to be much more important in the longer term, particularly if that is hotter than expected. You can ignore January and February as noise if you want to. If you get 3 months worth of data that's hotter than expected, it suddenly looks a lot more like a trend and a lot less like noisy data that you can relatively easily shrug off. So payroll's an interesting one, as always. Is it going to be a game changer in the longer term? I don't think so.
Well, I hope that's a kiss of death.
Probably will be, let's be honest.
But yeah, it's NFP is always a fun day to report. It's always the most wild one, or can be the most wild one of the month. We used to love it on the live floor, trading that one. It was when the pits were most packed. I think the usual rules apply, as they have been for probably the last year. If we're getting a positive number, sort of between 100 and whatever bubble number likes to pop up now and again, 300,000, then everything's tickety-boo as far as the headline goes. I think more importantly, the unemployment rate not showing any signs of worries there. It's going to take a big variation, like a jump to 4.2 or 4.3 from here, suddenly to get the market thinking, oh, here comes the bad news. And also those wages, average hourly earnings year on year been running around that 4% mark seemingly forever. So there's still some wage pressures still bubbling along there. Again, as we've seen in some of the PMI data, if you read the comments there. And I think that's the key number. Wages, if you're just looking at that metric compared to the Fed funds rate, are running negatively. Real wages are running negatively still. And so that's something that the Fed will want to perhaps narrow a little bit. But while the jobs market is ticking along, no one's worried about it. Always look out for a surprise. If it comes in minus 100k, then the market's going to make a move. Then we'll have to look deeper into the details to find out what's going on. Is it a one-off number? Is it the start of a trend? Market's going to panic. So it's always a volatile number. So you've got to be careful when trading it, obviously. But otherwise, it's a lottery number, and Michael will use his magic model sometime on Friday to get it wrong once again.
Got to get my blindfold and dartboard ready first. I'm glad you mentioned wages, because that real earnings growth is what is keeping services prices relatively sticky. So if you do see unemployment continue to tick higher, we've got the JOLTS data out actually later today. Hopefully that'll be, this video will be out before the data drops. That'll be interesting, particularly the quits rate. That's fallen quite substantially of late, because if we do see some easing of earnings pressures in the US jobs market, then that does bode well for services disinflation. And you're going to need that services disinflation to really kind of pick up the baton from the good side of the economy and really see that last mile back to 2% on headline CPI progress. But we've gone back to talking about inflation, which I said we weren't going to do. So let's try and move on to my least favorite topic in the world.
Oh dear, least favourite topic, but one of the biggest economies in the world, if not the biggest. And yes, we are going to talk about it. Sorry?
Apparently.
Apparently, well, they used to be. Not at the moment, if you look at the data. And that's what we're looking at here to see if perhaps they're going to start recovering from their recent weakness. Now, the PMI data came up green for China, with manufacturing moving back into expansion at 50.8. That was beating the 50.1 expected. Services also beating and moving into expansion at 53.0. Now those were the National Bureau of Statistics numbers, so the official state numbers. The more private-ish Kaijin numbers, PMIs, came in at 52.1 for manufacturing, which was just a point above expectations and too high than last month. Then it's at this point I'm going to hand it over to Michael for his usual moan up about the validity of Chinese data. So go on, I'm going to make myself a coffee while you have a rant about that one, mate.
Well, no, I think we've done that rant to death. I forgot to bring a bucket of salt with me to digest those figures. I mean, just anyone who takes those at face value, what are you doing? It's an interesting one. But I'm already off the Christmas card list in Beijing, so I don't think I need to go down that route again.
Yeah, exactly. You're crossing off most of the Pacific Hemisphere at the moment with friends. So anyway, I'll crack on. So these MBS numbers, they've only in manufacturing, they've only been sporadically positive, only 11 times in the last 31 months. So the Kaijin ones have been a bit more upbeat, but nothing is going really gangbusters over there. So while the MBS covers large state firms, the Kaijin covers more the SME side of things. We do have a broadly positive month so far, but in no way can we say this is yet the start of a proper recovery. However, trends have to start somewhere, and this is the first plus number since last September for those MBS PMIs. Now, if we see the next few months picking up also, then we might start to see a bit of a recovery gaining. Now, in the short term, looking at some of the assets, oil has been a bit more bid since that data over the weekend and earlier this week, but the yuan is still looking fairly weak at around 726, so the market isn't getting too excited on this data. However, it is something to watch if we see a decent pickup in China data, as that will drive things like commodities higher, maybe risk generally, and then we'll see a whole different shift in some of the assets that have looked a bit weaker over the last few months. So early signs, perhaps. I like looking at these data points to see if we're going to start to get an early trend, because that's when you get the best opportunities to trade it longer term. And we'll keep watching this data over the months ahead.
Indeed, yes. It's going to take a lot more than one or two manufactured PMI numbers being above 50 to turn me bullish on China, but each to their own. In any case, let's move on to some charts in That's a Setup. Right, I want to get things cracking with cable this week, which you can see we haven't planned the show very well because Ryan is going to talk about cable a little bit later on as well, I believe. So we will keep this relatively short and sweet. Cable got interesting in the early part of March as we broke to the upside of this 126, 128 range that's been in place all the way back since last December. But we really couldn't sustain that upside at all. We had a very, very brief foray up north of 128.5 towards the 129 figure. And then it looks like the pound bulls got scared and all backed out of the market, and the dollar has rallied pretty strongly since as that US exceptionalism theme has come back in. And yesterday we actually saw cable trade all the way back down to the bottom of that range and close below its 200-day moving average for the first time since early February. So I think this is an important break. It's one that I've had on the radar for some time now. And we were discussing earlier that the risks are tilting increasingly towards the Fed becoming a little bit more hawkish than market expectations. I think the risks also point to the BOE becoming more dovish than market expectations. I think markets are probably underpricing the chances of a rate cut in June at this point, particularly when inflation is likely to fall below 2% in April and May. And this is a point that my good friend Adam Linton has made a couple of times recently. So this is a break that I would be happy to run with, a stop just north of that 200-day moving average in case we go back into that prior range. And perhaps we might even get a break below that 125 figure if we get a hot ISM services number and a decent payrolls print later on in the week. Ryan, I'm going to forbid you from talking because I know you want to talk about cable later on. So we will go back to my favourite subject again, which is China.
Oh dear, I don't do it on purpose, I promise you.
I feel like someone's on a wind up here.
We've spoken about Chinese data, so it's only apt to talk about the Chinese yuan and whether officials are fighting a bit of a losing battle at the moment. It took a bit of a jump, dollar yuan, a couple of weeks ago. That was largely due to the dollar move, the dollar rallying, but it still forced Chinese entities to come out with hit it with intervention, which had a much more weight than it's had recently. The move to 728 saw them knocking it down to 723s, but it's crept back up since we're back into the sort of 726s again. Now, this 728 level is a bit of a gateway to the 730s and those prior highs up around 736. And China intervening more strongly up here maybe shows where their pain level lies for the moment. Now, the great thing about trading this pair is that they are very clear about when the yuan is too strong or too weak. So if this 728, 730s is a deciding factor for them, they will be pretty clear about that. Now, I'm still short from last year up at the 737 level, 736 highs. And it's a real decider for me whether I add back to the short or I look to fold and potentially even go short. And that will be decided by any language from China. If they're happy to let it roam higher, I'll probably fold the short, as I say, and maybe even go long. If they are against yuan weakness around those levels, I'll look to maybe add to my shorts because very rarely do you get an asset that can move or can come with such clear directional language from officials. And that's very tradable in this pair, and hence why I love trading it quite often because they can set the line where you can turn your trade around or take profit and then reverse a trade.
Yeah, that's a very good point. As you say, it is something that basically just goes where the government wanted to at the end of the day. I think it is pretty clear that the authorities are getting quite worried. There were some reports overnight by Reuters that local banks have been buying CNH and CNY. There were also some reports by Bloomberg, literally just before I came in to film, that some swap trades had been forbidden as they were outside of the 2% trading ban that the PBOC like to keep things things within. So it's quite clear that I think that the authorities are becoming a little bit more concerned. Implicitly, I think the key, as you sort of alluded to there, is what they say explicitly, and I think that is really going to be when we do get that statement and those remarks. I think that's going to be the catalyst to give this another kick. And until then, we will probably continue to grind weaker and weaker.
Yeah, very much so. And they won't come out and put a number on it, but we've had comments before from some of the entities over there. They'll say, like, if there's been a move that's pretty strong one way, they'll say, okay, don't think this move is going to go one way forever. And that's usually the key to say, okay, that's a top or a bottom, and now I'm going to start trading the other way. So they are very explicit when they want to be. They haven't been very explicit recently, hence why I think if we do get up to this 728, 730s area, we might start hearing some stronger words from them.
Yes, I tend to agree with that. Right, let's move on. I want to talk about gold. The yellow metal has found a little bit of a shine once more. Sorry for the awful puns. We have traded to fresh all-time highs. It wouldn't be the trade-off without a pun. We've traded to fresh all-time highs in both the spot and the futures market. That's easy for me to say. North of $2,250 an ounce in the spot market, although we did pull back from that level after the hotter than expected ISM manufacturing data yesterday. I think there's a couple of interesting things about gold at the minute. The first is it's become, well, as you can quite clearly see from the chart, just a bit of a momentum juggernaut at this point. It's just more buyers coming in and coming in and coming in and coming in, which in itself makes it pretty hard to fade a rally like that. You would ideally want to see some degree of consolidation around the highs before looking to open any shorts. And I think the other thing, and actually I tweeted this chart out yesterday, so do go and have a gander if you're keen to see it, is that the rally seems to have gone under the radar a little bit. Normally when gold hits an all-time high or gold is rallying, the volume of talk about it on Twitter and on Bloomberg and on all of the financial channels is just ridiculous. It's off the scale. But there really hasn't been any noticeable uptick in mentions of gold in news stories as it has hit all-time high after all-time high. And I think that in itself is relatively interesting. But perhaps the most interesting thing for me is the fact that gold has moved in, frankly, the opposite direction to where you would argue it should be going in terms of the key drivers of the yellow metal. You think equities are moving higher, so risk appetite is relatively firm. The dollar continues to gain ground. The Dixie has gained for 3 weeks in a row, I believe, at this stage. And real yields are actually moving higher, as you can see in the gold line on this chart, which is an inverted scale on the left-hand side. So, as I said, I don't think this is really something that you can just sit here and go short at market, because it is a bit of a juggernaut in terms of moving higher. But I think if we were to see a bit more of a period of consolidation, if we were to get some relatively strong data out of the United States this week, then I think there is a relatively firm case to say that actually a decent chunk of the move that we've seen of late is built on what I would term relatively shaky foundations.
Yeah, it's interesting, this one, because again it falls into the realm of China. China are very big buyers of gold, and I've seen a few pieces out over the last couple of weeks saying that China, they're really hoovering it up at the moment. And it was no surprise to see just over that January-February period when it did start to consolidate and pull back a little bit. That was when China were on their New Year holiday, and since then it's just been a one-way train all the way up. And like you say, when you get momentum like this, you don't want to stand in its way until you get such evidence that we have formed a proper top. So yeah, I think there's still a bit of risk trading in this one, in terms of the geopolitical risks that we've got going around in Russia and the Middle East, the Red Sea, and things like that. So I think there's an element there, but it's really one of these assets that's going and going, and you're just not 100% sure why it's still going, apart from the fact that there's more buyers than sellers still, which then again plays into the realm of what I've been saying about China. So yeah, this one's not for turning at the moment, and as such, it's like the S&P. That's keeps going and going and going, and I know you're going to talk about that shortly. So for the moment, yeah, you just got to go with it. You don't want to buy it up here right at the top. You need to wait until you get a decent pullback and to a support point that gives you a bit of conviction that you can get into longs, and that's looking at things like former break points on the way up. But for shorts, if you keep tapping it up here, then you're going to be facing some pain still, I think.
Yes, indeed, and I'm very glad that we're both sort of scratching our heads about this one. It is a little bit of a perplexing move, but as you say, it's not really a move that's there to be fought at the moment. Right, what about our last chart this week, Brent crude?
Yeah, Brent is the one I'm going to be looking at, my last chart. And as well as China seeing some better data, there has been some increased optimism about growth continuing in the US and improving elsewhere, like the UK and Europe. Now, all this has led to oil markets sort of firming up in the last few weeks. In fact, it's been rallying pretty much all of 2024 so far. Now, as just mentioned, there's also some geopolitical factors at play with the damage to Russian refineries and continuing OPEC plus output cuts. Now, despite all this, oil and Brent in particular still feels like it's just one bad data point or headline that would send it all the way back into the low 70s. So I'm not confident in this rally that we're seeing, but the price is where the price wants to be for now, and we're at a bit of a level here in the 88-89 zone, and if we can cement this break, then we should be on for at least a test of the late 2023 highs around the $96 mark, maybe even a crack at the big $100 mark. Now, for support, we're looking at around the $84-85 level, and then down in towards $77-78 around that old 50 fib you can see on the chart there. Now, I wouldn't be a high conviction buyer on this break of 88-89, but would perhaps wait for a break and then a retest confirmation before stepping in and thinking that this was going to continue further. So it's looking fairly strong, but not a confident strong, and that's something that keeps me from getting in too deep in oil trades at the moment.
Yeah, it's an interesting one. I'm glad you've brought it up, actually. And we had news yesterday of some additional supply cuts coming out of Mexico, which has given the upside a little bit more juice. I've been, every time we've brought up crude over the last sort of 3 or 4 months on the show, I've been harping on about how we need a sustained pickup in demand in order to engineer a rally. And it looks like the data may well be starting to turn in that direction, as you rightly alluded to, from the manufacturing side of the economy, and whether or not we can believe it, the data coming out of China as well. So the stars may well be starting to align for a bit of a move higher in crude. And I would argue that it's almost the worst possible timing for a move higher in crude as well. We are probably 6-ish weeks away from the start of driving season over in the United States. If you were President Biden, would you want driving season with $4 a gallon gasoline prices at the pump across the United States? No, you probably wouldn't if you're trying for re-election in November. So I do wonder at what point we get to political pressure once more, we get to SPR releases and we go down that road once again. But I think that's a little bit of way off for now, but a theme to keep on the radar if we do see some sustained upside. As with so many assets and macroeconomic factors this year, they are going to be influenced substantially.
To hear you talking about the election going on over there, which I know is another one of your favourite subjects. But yeah, it's a very valid point, and those sort of things are going to be looked at over in the US. And if it keeps climbing higher, those prices are going up, and then obviously comes back to the old inflationary problem as well that you see across the globe. We'll see the inflation will be ticking up on the energy front as well.
Indeed, yes. And then we're back to the fun debate of whether rate cuts can influence supply-driven inflation. And oh, joy, can we not wait for that? That can wait for another day, though. Don't you dare. We need to move on to our plays of the day. Right, before getting into what I want to do this week, I did just want to make mention of Ryan, your play of the day last week. I think the FTSE is trading north of 8,000 this morning. So, we can all rejoice at that one. The UK benchmark is actually, and I know it's only 9:45, but it is on track for a record close. So fingers crossed the FTSE might finally be finding a little bit of love. In any case, I want to talk about US equities this week, as Ryan alluded to earlier. The S&P 500 gained a relatively modest 0.4% last week, but that's still a second straight weekly gain, and it is also a fresh record closing high for the index on Thursday, although we have seen the market pull back a little bit after those ISM figures that we got yesterday. But I think what's interesting not only is the fact that we continue to print new records, and there's few signs that are more bullish than that, it's also the fact that there are ongoing signs that the rally is broadening out and there's more participation in the upside. We saw small caps outperform last week. The Russell 2000 was the best performing of the four major US equity benchmarks. And actually, if you dig in to a constituent level of the index, we now see around 3/4 of index members trading in the green on a year-to-date basis. At the end of January, that was only around 45%. So some nice increased upside participation. Naturally, I'm still bullish. I think the path of least resistance continues to lead us higher. Dips remain there to be bought, particularly if they get down to around the 50-day moving average, which I think is about 4% downside from where the front S&P currently trades. The next real catalysts come, as we said earlier, the 10th of April, inflation. The 12th of April is when earnings season kicks off on Wall Street. But I think until then, the market is going to grind steadily higher. And as you can see on the chart, there's a little bit of favourable seasonality in the mix as well as the second quarter gets underway. Ryan, you're discussing the pound.
Oh, I'm allowed to talk about it now. Am I seeing I was banned?
You are. You're no longer silenced, mate.
Yes, the gag is off. And I'm looking at a bit of a range play here, taking the other side of the view that Michael has. I'm going to actually take the easy route and rehash my FTSE play of the day from last week as it was still playing out. I was still waiting for that test of 8K, but that's happened now, so I'm going to have another look at that one. I thought I'd go fishing in another pond, though, and this pond is cable, pound versus the dollar. And I'm going to be looking at longs into this 125 big figure, which marks the edge of the wider range between 125 and 128. And it was a former break point late last November, and it's subsequently held on a retest. So that's one of those confirmation moves I look when we get a break and it sets up the level as a bit of a support. This one doesn't need a big stop below 125, but as we also have another big level, 124.50, as you can see by that red line on the chart, I might look to split my risk and play both levels with a stop under the 124.50. But in essence, I'm looking at longs down here just to see if we maintain this range.
Good stuff. Long cable and long the FTSE. That is a slightly brave combination. We will see how that pans out.
Short.
Oh, you're short. Oh, sorry.
Yeah, I was looking at shorts up at this 8K level, so we'll see whether that pays off. I might have two play of the day results next week.
You may do. I would take just one at this point. Right, in any case, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for interrupting his Easter break and for joining us, as always. Thank you also to our producer, Kyriakos, for bringing this together as brilliantly as he always does. We hope you've enjoyed the show. If you have, drop a like on the video. Leave a comment as well. Let us know your thoughts on the markets and any topics you would like us to cover this time next week. It is a busy week ahead in the markets, and it's an even busier week next week. So there will be plenty for us to discuss and digest then, which is when we will be back on your screens. In the meantime, thank you very much again for watching, and goodbye for now.